Is it possible that the Federal Reserve is making a massive mistake and that inflation is actually zero? Yes, I know. If inflation were actually zero, we wouldn't be worried about diesel shortages. We wouldn't be worried about Russia tearing up its Ukraine export agreement for wheat. We wouldn't be worried about near-term inflationary pressures. And quite frankly, if inflation were zero, we would not even be worried about those darn FOMC meetings, because we know at every one of these FOMC meetings, the Federal Open Market Committee meetings put on by the Federal Reserve, we become fearful that the Fed is going to tell us they have to raise rates more to tame inflation, as they have done every single last report that we've had. And unfortunately, we know that the Federal Reserve is really sensitive to what's pronounced or at least outlined in these CPI reports and job reports. In fact, look, here's an article from the Cato Institute which tells us that as soon as we saw CPI data coming out, you had articles in the Wall Street Journal and other sources immediately saying that's it. This solidifies rate increases from the Federal Reserve. In other words, the Fed likes to say, oh no, we have different metrics. We don't like to use the CPI either, because really, prices probably weren't up 8%. They're probably up more like 15% year over year, let's be real. But the CPI could ironically also be keeping the Fed, even though it's not super accurate for us as individuals, could actually be keeping the Fed substantially more aggressive for a lot longer than they should be, because of data that the Cato Institute breaks down. And we're going to talk about that data in this particular video. Now, look, there are a lot of different arguments about what's going on with the Federal Reserve and what's going on with interest rates and inflation. Most important thing to know is the next meeting from the Fed is November 2nd, and we actually won't even get a lot of good data before then. We just had the employment cost indicator, which did indicate that inflation and wages is still around, which unfortunately wage-based inflation is probably one of the biggest concerns that we have. If you jump over to a JP Morgan report here, you'll see that a wage price spiral being noted as possibly developing is a real risk factor and something that the Federal Reserve is watching and being very careful of. But one of the things to realize is for this next Fed meeting, and we're not expecting many changes. Why? Because between the next Fed meeting on November 2nd and the one in the second week of December, I believe it's right around December 13th, you end up getting a jobs report on November 2nd. You get a CPI report the week after that. You get another jobs report the first week of December. You get another CPI report after that. So don't expect any changes from the Federal Reserve anytime soon. This video is designed to be something for you to think about for the longer term, because it could really change the way that you invest. So let's go ahead and jump on into exactly what the Cato Institute says, because for now, we've already known that goods inflation is expected to slow. We're expecting to see not only supply chains normalize, but we're also seeing container costs decline. We are seeing used vehicle prices decline. We expect CPI to trend down over time. CPI is this white line, but we do expect it to take time via this blue line, which is a little frustrating because unfortunately, even though inflation is expected and forecast to drop, this model here by the Bureau of Labor Statistics and the forecast by JP Morgan here, we're still dealing with really high inflation now. But is it possible the Fed could be making a big mistake? Well, take a look at this. The Cato Institute just released a piece entitled CPI Less Rent Was Zero for 3 months, and basically suggesting that the CPI is wrong to the downside. Now, historically, we've been thinking about the CPI being the CPI because it's probably, inflation's actually been a lot higher. But what if it's actually now flip-flopped and the inflation that we've been experiencing is now behind us? We're still stuck with higher prices, but we're not getting increasingly higher prices. And what if that means the Fed would make a big mistake? See, remember how inflation works. If you have a widget that costs $100 year zero, and the next year that widget costs $110 year one, we're still dealing with 10% inflation. That has not changed. But if the year after that, let's just call it the now, that is still $110, that being the now, we technically have zero inflation. Now, don't get me wrong, you're still paying the higher price, but we have zero inflation. So is there a case that there's actually zero inflation right now? Yes, that is exactly what the Cato Institute is telling us. Let's take a look at their breakdowns. Oh, right after I mention that we have a Halloween coupon code expiring for the programs on Building Your Wealth. There have been some questions on the differences between the courses. We have a new course coming out called the Elite Hustlers University course. This is all going to be about entrepreneurship, business development, income growth, and career growth. That's coming soon. It's not actually for sale yet. But in the meantime, we do have a Halloween coupon code for all of these programs right here: real estate, stocks and psychology of money, YouTube, do-it-yourself, property management, and rental renovations. Of course, for these, you still get lifetime access to the course member Q&A, fundamental live streams, new lectures coming, and there will be a price increase for these here. So take advantage of the Halloween coupon code, jump in on these, and stay tuned for the announcement for the Elite Hustlers program. But for now, take a look at this. This is the core argument made by the Cato Institute. They say, if you look at this chart very, very closely, and you say, hey, wait a minute, let's go ahead and zoom in here and say, wait a second, consumer price index for everything less shelter, then we want to pay attention to these little bluish lines. Okay, so let's do that. Where are the bluish lines? Wow, they're right over here. They're actually negative. And see, we can see that clearly when we zoom in here. Look at this. Here's the 0% line right here. And both of the all item lines less shelter, that's the seasonally adjusted and the non-seasonally adjusted lines, for the last 3 months have been below zero. So negative or zero. Take a look at that right here. July, August, September. Both of them, seasonally adjusted and non-seasonally adjusted, have completely collapsed. So what's actually keeping inflation up? Well, the only thing that's keeping inflation up in this recent trajectory here, it's kind of like that $110 widget is $110. You look back a year ago, you're like, Kevin, it's still more expensive. I'm still paying more. That's right. But it's not going up anymore. That is potentially a big game changer that the Federal Reserve appears to be blind to. And that's a really big risk that the Federal Reserve could end up over-tightening, forcing a recession much more so than they actually need to. The Cato Institute suggests the following, and these are some pretty incredible notes. Okay, look at this. What makes 3 months of zero inflation in all items less shelter more remarkable is that, listen to this, folks, it includes energy and food. It also includes other CPI service items based on last year's data, such as health insurance, which is based on industry profits from 10 years ago and soon to fall. The Cato Institute isn't the only one projecting that we're expecting to see large declines in healthcare costs. Remember that JP Morgan report right here? Look at what the JP Morgan report told us the largest likely decliner was going to be in September of 2023. Look at that, expecting a 39% decline in inflationary costs for health insurance, while shelter still remains at 7.5%, which is also, look at this right on the right side here. See this column that says share of core inflation? Negative 39% on health only makes up 1% of the CPI, whereas you jump over here, 7.5% on rental inflation, you're at 41.6% of core. Now, why is that such a problem? Well, it's such a problem because the Federal Reserve, even in the other indices that they use, overweight shelter. And not only do the CPI indicators and the measures via PCE indices that the Fed uses overweight shelter, not only is that the case, but shelter inflation has already started to peak. By most accounts, if we stop using these measures like owner's equivalent rent, we start seeing that inflation actually peaked around May or June. So what is owner's equivalent rent and why does everybody keep talking about it? Well, here's just basically how this would work. If owners are surveyed and they're asked, hey, how much do you think your property could rent out for? They might think, Well, over the past few years, we've seen properties in our neighborhood rent for $2,500 a month. So that might be your owner equivalent rent survey. The problem with this measure is it doesn't tell you what's going on with current rents. Current rents are generally defined by asking prices that actually end up having leases associated with them. In other words, closed rental comps. So somebody lists a property for $3,000 and then that leases and it shows up as a leased comp at $3,000. We know rent has actually gone up, in this case, by 20% to $3,000 a month, which is kind of what we've seen nationwide. However, when you look at what Zillow and CoreLogic and almost every single leading indicator for rental inflation tells us, almost every single one of them tell us we hit a peak in May or June, and we've already started to see the inflection to the downside. The problem is the CPI continues to focus on this, and this number is still trending up from 2,500 to 3,000, very, very, very slowly. So now we have a double problem. We have a Federal Reserve that is giving way too much weight to these nasty matrices for rental inflation. And yes, it's catching up, but the problem is there's so much weight on that rental inflation that we're actually telling the Fed, hey, inflation is so high, but the biggest thing that's really contributing to that rental inflation is right here. It's rent. Because again, if you look at all items less shelter, what do you get? All items less shelter, there you go, under 0% inflation. You could look at this on the St. Louis Fed website. It's simple. It's just sad. It's sad because the Federal Reserve is doing us a dirty one. And so unfortunately, the Cato Institute suggests that it takes a long time to see notable changes in year-over-year inflation, and the Federal Reserve is making a big mistake being as aggressive as they are. Hopefully, this leads to some realization by the Fed over the next couple months that, hey, we do realize that these owner equivalent rents are kind of skewing the numbers a little bit. It's time for us to soften the pace of our rate increases. This could be a very bullish indicator to markets. Because here's the thing, the Cato Institute tells us that if monthly CPI did not increase at all in the next 3 months, in other words, month over month CPI was literally zero over the next 3 months, year-over-year inflation would still sit at 7.3% in October, which will be the November report we get, 6.4% in November, and 5.9% in December. In other words, we would have to actually see deflating prices, those widgets going from $110 to $105 again, to really see the backwards-looking year-over-year numbers fall more quickly. But we're not going to see that, which is very unfortunate because now we have to wonder, okay, so the Fed is looking at data that is substantially lagging reality. How do we position ourselves and invest for the potential that the Fed realizes we screwed up, we need to slow down? Well, I think it's pretty obvious. The more the Fed keeps hiking, so if you think the following, that the Fed needs to keep hiking because you actually think that inflation is going to get worse, you don't even really care about this. You just think inflation is going to get worse, rental inflation is going to continue to get worse, even if it inflected down a little bit, everything else is getting more expensive and you don't see it going down, then you want to be invested in things like cash or probably treasury bonds and bills, cash-like instruments. Although these will lose value unless, of course, you're just sitting in them in an inflationary environment. T-bills will lose value unless, of course, you're sitting in them just milking the yield, and then it doesn't matter if their market value goes down. Generally, cash is the best thing to have in an inflationary environment where the Federal Reserve is continuing to hike. Now, I know that seems counterintuitive because you might be thinking, oh, but my cash is losing purchasing power. Well, it depends what you're going to buy. If you're going to buy things that are going up in price, like food and gas, yes, your cash loses purchasing power. But if you're planning to buy assets, whether those are bonds or it's real estate or it's stocks, your cash actually gains in purchasing power during an inflationary environment where the Federal Reserve is hiking. Now, if you believe that it's possible in this November meeting and December meeting that the Federal Reserve finally comes around and goes, hey, we actually think inflation is meaningfully going down, because when we start realizing that shelter is sort of being mislabeled here and being misread, and this is something historically we haven't seen. This is sort of like a "this time is different" moment, which are very dangerous words in investing. But I mean, the fact is, this is pretty unique. If the Fed comes out with that, well, then you're probably going to be looking at a Fed that's more dovish. And a more dovish Fed would imply you probably want to be in things like cyclicals, which could be tech, it could be growth. However, these are still sectors that could experience an earnings recession, as we've already been seeing with Google Ads plummeting, with Facebook plummeting, with Amazon seeing growth slow for the next quarter. So you're still going to see that EPS risk and decline in potential margins, which is a risk. But a dovish Fed almost always pushes up those cyclicals, it pushes up growth stocks, generally good for stocks in general. And you have to ask yourself, as soon as we get a dovish pivot, is it possible that spreads on mortgages come down and we actually end the real estate crisis and collapse before it meaningfully actually has a chance to decline? If the Fed U-turn in, let's say, January, and all of a sudden mortgage rates fell down to, say, 4% again, is it possible then that the real estate market maybe sells down 8-10%, but then quickly rebounds another 3-4-5% as everybody comes out of the woodwork to go buy real estate? Absolutely possible. So, important things to keep in mind. By the way, we've got a big deadline for House Hack coming up on the 31st. Make sure that if you are an accredited investor and you want to join House Hack, you join by October 31st. Sign your agreement. You could wire within a week after that. Just make sure you sign by October 31st. And if you're not accredited yet, don't worry. Stay tuned. We will have our non-accredited round coming up, hopefully within the next few months. Thanks so much for watching, and good luck.